Want to get paid just for holding stocks you already own? Sounds too good to be true, right? Well, it's not. Let me introduce you to Covered Calls, a powerful income-generating option strategy that smart investors use all the time. Once you learn the magic of covered calls, you'll never look at your long-term portfolio the same way again. Before we jump right in, let's make sure we're on the same page. A call option gives the buyer the right, but not the obligation, to buy a stock at a set price, called the strike price, before a certain expiration date. Think of it like a reservation to buy a stock at a specific price, even if the market price goes higher. If you're totally new to options, you can also check out our earlier video, Jumpstart Your Option Journey, where we break it down step by step in plain English. So what's a covered call? It's when you sell a call option on a stock or ETF you already own. Think of it like this. You're renting out your stock. You still own it, but you're allowing someone else the right to buy it at a set price in exchange for cash, the premium. Because you already own the shares, you're covered, meaning if the buyer chooses to exercise the option, you've got the stock ready to go. No surprises, no scrambling to buy shares at the last minute. Imagine you own a house that you're not planning to sell anytime soon, but someone offers you money now, just for the right to buy it from you at a set price in the next 30 days. If they buy it, great. You got your asking price and the bonus money. If they don't, you still own the house and keep the cash. Here's why investors love this strategy. You get paid up front. That's the premium from selling the call. Cash in your account right away. If the stock doesn't hit that strike price before expiration, you keep both your shares and that premium. Free money? Not quite, but it's very close. This strategy shines in sideways or slightly bullish markets. If the stock stays flat, you're happy. If it goes up just a little, still happy. If it pops, even better. You sell at your target price and walk away with profit plus the additional premium. Let's run a quick example. Say you own 100 shares of Apple, currently trading at $200. You sell a covered call with a strike price of $210 that expires in 1 month, and you collect a $2 premium per share. That's $200 premium in your pocket up front. Now, two things can happen. One, Apple stays below $210. Your option expires worthless, and you keep your shares plus the $200 premium. Two, Apple goes above $210. The option is exercised, and you sell your shares at $210, locking in a $10 gain per share or $1,000 plus the $200 premium. Not a bad month. Covered calls are ideal when you're neutral to mildly bullish on a stock and wouldn't mind selling it at a certain price. A pro tip? Choose a strike price where you'd be happy to take profits anyway. This way, you're never disappointed if your shares get called away. Now, here's the catch. Timing matters. Don't write covered calls right after a stock crashes. Why? The premiums will be low, and you might end up capping your upside right when the stock is ready to bounce back. Also, keep this in mind. If the stock rallies hard past your strike price, you'll miss out on those extra gains. That's the trade-off with covered calls. You get paid up front, but you cap your maximum profit. That said, if you sold the call at your target exit price, the upside you missed is irrelevant. You were planning to sell there anyway, and you got paid to wait. It could even help you be disciplined in taking profit. A wonderful tool indeed. Here's one more important tip. Only use the covered call strategy on stocks you're happy to hold long term. Remember, when you sell a call option, there's always a chance the stock doesn't get called away. So if you're stuck holding it, you want it to be a company you believe in, not something you'll regret owning. Think solid, high-quality businesses, the kind you wouldn't mind keeping through ups and downs. And another thing, don't get tempted by crazy high premiums on unstable or risky stocks. Sure, the income might look attractive up front, but high premiums usually mean high risk. These stocks can crash hard, leaving you with heavy losses that far outweigh any small premium you collected. It's better to earn steady, reliable income from stable stocks than gamble with volatile ones. The final golden rule? Never, and we mean never, sell covered calls on stocks you believe have massive upside. For example, if you're holding a small-cap tech stock you think could double in a year, don't cap your gains for a small premium. Save this strategy for your more stable, slower-moving positions. Covered calls are like earning rent on your stocks, steady, repeatable income for patient investors. If used wisely, they can turn a boring portfolio into a cash flow machine. Just be smart with your strike prices, know when not to use them, and you'll have one more powerful tool in your investing toolbox. Thanks for watching. If you found this helpful, drop a like and subscribe. And don't forget to check out our playlist on option strategies and investing tips to level up your investing game. See you in the next one.